Welcome to the presentation on Standard 6 Conflicts of Interest. Standard 6A is Conflicts of Interest, Disclosure of Conflicts. Let's read the standard first. Make full, fair disclosure of all matters that could reasonably expected to impair independence and objectivity or interfere with duties to clients, prospects, or employer, and you must ensure that disclosures are prominent and delivered in plain language. So the first point here to note is that in the investment industry there are bound to be conflicts, and at times there might also be a perception of conflict, and in order to protect the interest of investors and employers, we as members or candidates are required to follow Standard 5A. So any possible, even if there is a chance of a conflict, we are supposed to disclose that conflict. The way we will look at this standard is by breaking down the conflicts, the different possible conflicts with employers, clients, and so on. So let's just start with the disclosures of conflicts related to employers. Now, what are the possible conflicts of interest and what are the possible disclosures here? One possible conflict is if you have stock ownership. So if you have ownership in, say, stock Hubco, and your employer is a market maker in this stock, then clearly this stock ownership of yours needs to be disclosed in writing to your employer. Similarly, if you are, let's say, on the board of Lucky Cement, and your asset management company or advisor or let's say your company makes recommendations related to this company. So here again, disclosure, you must make the disclosure to your company that you have a close relationship with this organization. Even financial pressures that you might have. So this becomes a little personal also, but if there are financial pressures on you which might impact some of your actions, there might be a perception of a conflict of interest here, and even this, according to Standard 5A, must be disclosed to your employer. Obviously there are other examples too, but what I have just given you represents some of the most commonly seen examples on the CFA exam. Now, what sort of disclosures must you make to your clients? Here again, stock ownership is important. If you are making recommendations to your clients, you need to disclose whether you own some of those securities that you are recommending. Secondly, disclose any compensation arrangements that you have with your employer which might impact the recommendations that you make. So essentially, any matter that could impair your objectivity when you make suggestions or recommendations to your client must be disclosed. And if your firm does not allow such disclosure, then you should consider dissociating yourself from that activity. Another important point is the relationship with a possible issuer. So here again, if you are, let's say, making recommendations to buy or sell shares in, say, Fatima Fertilizer, and you have a consulting arrangement with this company. This consulting arrangement, obviously your objective or your incentive might be to keep this client happy, and to keep this client happy, you might potentially make a buy recommendation to your client. So your client needs to know that you have a consulting relationship. Similarly, if they are investment banking relationships, underwriting relationships, or if your organization has is a market maker for this security, all this information or any of this information must be clearly disclosed to your clients. And finally, you must disclose any benefits. So any benefits from investment recommendations. What's an example of this? Let's say that if your client, who's an investor, buys units of a certain mutual fund, then your firm gets a rebate based on based on the fees that the client is paying the mutual fund. So here there is a potential conflict of interest where you might recommend shares of a mutual fund or units of a mutual fund based on the rebate that you get, and clearly that rebate arrangement needs to be clearly disclosed to your clients. Continuing with some other conflicts, what are cross-departmental conflicts? So these conflicts are within a given firm. If you are, say, a sell-side analyst in the research department making recommendations on buying and selling of securities, there might be pressure on you from the investment banking group, which, let's say, has a relationship with XYZ company. So there would be pressure on you to make positive recommendations related to XYZ. So what are the disclosures that you need to make? So if your organization has any sort of relationship with the securities that you are covering, that needs to be disclosed. There might also be pressure on buy-side analysts. So here, let's say that you work at a pension fund, or let's say you work at a bank, and you are a buy-side analyst involved with analyzing a given firm and determining whether or not to buy shares in that firm. There might be pressure from your marketing department that is seeking a separate relationship with ABC company that you are analyzing. So any such conflicts also need to be disclosed. Stock ownership has been mentioned before, but given the importance of this item, it needs to be re-emphasized. For sell-side analysts should disclose any materially beneficial security ownership. So if you have shares of FFC and you are also writing research reports on this company, clearly that needs to be disclosed. Buy-side analysts should disclose reporting requirements for personal transactions. Let's say you are a director at a firm, so you are on the board of directors, and your firm also deals with that security or makes recommendations related to that security. What are the possible conflicts here? There are three broad conflicts. Number one has to do with duty to clients versus duty to shareholders. So as a director or as a member of the board of directors, you have a duty to the shareholders of, say, ABC company where you are on the board. What about duty to clients? Now, if your investment firm also makes recommendations related to ABC, then clearly there is a conflict of interest. As a shareholder in ABC or as a director, you might get shares in ABC or you might get options, and clearly then there would be some conflict of interest because you might take some trading actions that would increase the value of this security. And finally, as a member of the board of directors, you could possibly have access to material non-public information, which could also create a conflict. Given the tremendous amount of conflicts, generally the best way of dealing with this is to isolate yourself from investment decisions, or the firm needs to ensure that if somebody is on the board of directors of a given firm, that person should not be involved in any recommendations related to ABC, and that can be handled through firewalls or other restrictions that we have spoken about in earlier standards. Let's now talk about standard 6B, priority of transactions. Investment transactions for clients and employers must have priority over investment transactions in which a member or candidate is the beneficial owner. So given the strategy we've used all along, we'll just talk as if you are the member or candidate. So the first question here is, what do we mean by beneficial owner? So the beneficial owner could be you or close family members and so on. So just because you don't own a stock, but let's say that your spouse or your parents own a given stock, then any action that you take that would benefit your close family member would still have to be taken in the context of standard 6B. Avoid potential conflicts of interest. Does this mean that you are not allowed to make any personal investments? That is not the case. Realistically speaking, you are allowed to make personal investments as long as the investments that you make do not disadvantage the client in any way, as long as you do not benefit personally from any sort of transactions that you do for your client, and as long as you comply with the law. So as long as these three conditions hold, then personal investments are fine, even if these investments are in stocks that potentially you are recommending to your client or buying for your client. Client and employer transactions take priority over personal transactions. Specifically, what this is trying to avoid is any sort of front running. Just to understand the potential conflict over here, let's say that you are planning to recommend FFC for your client, or you're planning to buy lots of shares of this stock, since we are now talking about transactions. So you're planning to conduct a huge transaction of this share for your client, and recognizing that as soon as you start engaging in this large transaction, FFC shares will go up. If you do some front running, which means that before beginning this transaction for your client, you buy for yourself or for your close family member these shares. What's wrong with that? Here what you are doing potentially is taking advantage of the client, or taking advantage of this client transaction to benefit yourself personally, and this would be a clear violation of 6B. Note also the priority. When you are doing transactions, the client comes first, then any possible transactions for the employer, and finally for yourself. Another important point that frequently comes up in CFA questions is related to family member accounts, where the family member, let's say your sister, is one of your clients, and she is paying her fees like any other client. Now you must treat your sister then like any other account. You cannot say that since she is a family member, you will treat her the way you treat her shares the way you treat your own shares. That would not be correct. As long as she is a regular client for your organization and pays fees like any other client, then she must be treated like any other account. So what are some possible procedures that you need to keep in mind with regards to priority or transactions, or 6B? Number one is limited participation in equity IPOs. So as we've seen in earlier standards, equity IPOs create lots of potential conflicts of interest. If you are possibly dealing with a hot IPO where the perception is that this IPO price will rise a lot, then for you to personally take a stake in this IPO could easily be seen as a conflict of interest, where it might seem like you are depriving your clients of the potential benefit of the IPO. Hence, your firm ideally should have guidelines and procedures in place that in general limit participation in equity IPOs. Restrictions on private placement. So these are a little bit like IPOs, and we will study these in more detail when we do alternative investments later. But private placements, one example is venture capital deals, where you might get a stake in a small private company where the value is expected to go up a lot. Here the conflict is that it might seem like you are benefiting from this increase in value at the expense of your clients. So again, it would be best if there are restrictions on venture capital deals. It might also seem that you are getting this deal or this share for any past work that you have done, which again would create possible conflicts. Ideally, your firm should establish blackout or restricted periods to avoid front running. We talked about front running in the earlier slide. So the point would be, if your organization knows that a large transaction is going to go in for XYZ stock, then prior to that transaction there should be a blackout or restricted period where employees are not allowed to transact in these shares. Ideally, there should be a disclosure of holdings. So your firm needs to ensure that employees disclose holdings of any shares or any companies in which the firm has dealings. So this can help identify potential conflicts of interest. And then beyond that, it's important to review employee trades. So this way, if employees know that their trades are being reviewed, then there is a disincentive to do any form of front running or to benefit at the expense of the client or to benefit through client transactions. Pre-clearance procedures, this ties with disclosure of holdings. So the firm needs to, if the firm has any pre-clearance procedures in place, this essentially says or describes the sort of procedures an employee must go through before he can buy and sell shares of companies in which the company might deal in. And finally, upon request, you must fully disclose to investors your firm's trading policies regarding personal investments. And finally, standard 6C, referral fees. Disclose to employer, clients and prospective clients as appropriate any compensation, consideration, benefit received from or paid to others for the recommendation of products or services. Now this is going to be relatively quick. Basically, you need to make complete disclosure about the fee that you get, and this includes the nature of the fee. So for example, if you are writing a research report for XYZ company and you are actually receiving a flat fee from XYZ company, that needs to be disclosed. Similarly, if for any other work that you are doing, you are receiving a percentage based fee or a performance based fee, that needs to be reported in its entirety. Now obviously, per earlier standards, you should not take up work where there is a potential conflict of interest, but in standard 6C we are simply talking about referral fees. So whatever the referral fee arrangement might be, it needs to be disclosed. In fact, even if there is any non-monetary benefit, that must be reported. So if you work for an asset management company and you refer a lot of business to brokerage firm ABC, and let's say that this brokerage firm gives you a bunch of Bloomberg terminals. So this is a non-monetary benefit which should also be reported. By reporting such benefits, basically your clients can evaluate the full cost of service that they are receiving, and they can also evaluate any potential biases and conflicts that might arise because of the benefits that you are receiving, or the other fees that you are paying or receiving. And finally, any disclosures that you make should be made before entering any formal agreement for services. And that basically concludes standard 6, which had 3 substandards A, B and C. And as always, you must go to the curriculum and carefully go over all the examples in order to fully understand how to apply these standards.